Okay, the stock market is always changing. Oh boy. Uh, After this week, that statement is clearly true. And as we always say around here, things are changing faster than ever. So today I want to talk to you about asset allocation, asset class correlations in particular, which I left off the slide here so you don't tune out right away. Asset class correlation sounds pretty far into the weeds for this time of the morning, but it's actually a very important subject, and it's actually quite straightforward. And you're gonna have a better understanding of what asset classes mean, how they change, what the relationship is, and why they're really more important now than they ever have been. Start out with Jesse Livermore. I like Jesse Livermore quotes. Um, he was a very renowned investor, a very prolific writer. Thank goodness, he wrote down so much stuff. He was investing from the late 1800s into the 1920s, and he made and lost multiple fortunes, large fortunes, and he was willing to write about his successes and his failures. So he's a wealth of knowledge. And one of his favorite quotes is, uh, "Another lesson I learned early is that there's nothing new in Wall Street. There can't be, because speculation is as old as the hills. Whatever happens in the stock market today has happened before and will happen again." And what I really think that's true, because human nature is one of the only constants across all market cycles. Even AI is not going to change that right away. The We're still in the mix here. Everything that we do is still ends up in the market. And while the stock market structure constantly changes, it doesn't stay the same. It's always new. Human nature is always there, and that's the part that remains the same. That's the part that we can get a reading on. That's one of the reasons we're trend followers. We follow what people are doing. We follow the money, and that's important, because that's not what happens in that pie chart modern portfolio theory portfolio. And we're gonna get into that a little bit this morning. This is the classic diversification pie chart. It's about 60% stocks and it's 40% bonds, in a balanced account. And all of the allocation percentages, all of these percentages of how much you should own, they're all created by historical averages, past performance. What have these asset classes returned over long periods of time? And we're talking 80, 90 years of data all get rolled into this. That's modern portfolio theory. That's the theory that runs most portfolios on Earth right now. Of course, in reality, past performance is no guarantee of future results. That little line is on any chart that any securities firm has ever handed out to anyone. But the important thing is that it's true. Knowing what things have returned in the past adds no predictive ability to this process. It just becomes interesting data. But if you're in an MPT strategy, if you're in modern portfolio theory, it is used as a predictor for future returns, as well as how those asset classes relate to each other going forward. Unfortunately, there's really not much data that says that's even legitimate. Let's take a look at that. Why do historical returns of these asset classes, why don't they carry the weight that they're imagined to? These are graphs of industry weightings in the United States and the UK in 1900 and again in 2025. Take a look at the size of the railroad allocations in 1900. Enormous. It looks 60% in the US, almost 50% in the UK. Railroads were absolutely in charge. If you've ever read The Intelligent Investor by Benjamin Graham, that's one of the most famous books on investing ever written. You know that he kept writing about railroad stocks. Everything was about railroad stocks. Well, it was written in the 1940s, and Graham grew up when railroads ruled the day. That's what was most in charge of the economies of the world. It's not the case anymore. If you see a 60% railroad allocation in 1900 and you look for railroads in 2025, they're not here. They might be built in here in a little slice of travel, but that's that's kind of it. They're not there. You might count them as utilities, but there's nothing like that in 2025. And let's take a look at tobacco. Tobacco in 1900. Um, in the U.S., there's a nice large allocation to tobacco. In 2025, not on the list. Look at the United Kingdom, 1900 tobacco, not on the list. But in 2025, pops up over here again. So it's moved. It's moved from 1900 in the United States to 2025 in the United Kingdom. It's a huge shift, but that's not even recognized in modern portfolio theory. All of this history is baked into today's account. And sometimes those asset classes just aren't even similar. Have you guys checked your telegraph allocation lately? What's your exposure to telegraph these days? There was a large allocation in 1900. Not on the list anymore. Telegraph was a larger piece of the U.S. economy than all of telecoms is today. Even with what we do with telecommunications in 2025, it's not even as big as telegraph was as percentage in 1900. So the point here is that the changes are large, and should that old data have any place in building your portfolio today? And our answer, of course, is it's not. But if you believe in static asset allocation, if you believe in modern portfolio theory, you have to believe that asset classes don't change. And the relationship between asset classes does not change either. The data clearly does not bear that out. That is not what goes on in reality. But this data gets baked into your 2025 asset allocation. It's just one more data point. It's just as important as what happened last year, what happened in 1900 or 1920 for sure. That's just not, that doesn't make any sense. It's the economies aren't even similar. Let's take a look at who owns it. Who owns these markets? That can have a great deal to do with what drives people's decisions. Stock market ownership used to be heavily concentrated in the hands of households. Not anymore. Households still have the highest ownership percentage, 38%. That's this light blue part here at the top. This looks like the background. It's not. That's the percentage of household ownership, but it's down from over 90% back here in 1945. It was huge. Individuals owned almost everything. Um, Now that's significantly shrunk down, and the fund industry holds about a quarter of the ownership. And foreign investors, non-U.S. investors, almost a fifth of the total is owned by people who don't live in the United States. So obviously, households still own most of the stocks, but they own them through different vehicles, not just direct ownership, but through the stock market. So there's far more diversification in the ownership structure. I think that's a very good thing for the health of the market. Everybody's eggs aren't in the same basket. Um, but again, huge changes in who owns the equity market, which changes how the market reacts to both real financial changes or just speculative news or headlines. Boy, have we seen some headline trading this week, all about what might happen, but and the markets are going crazy. So it doesn't matter that professional investors own more. Everybody can react, but who owns this? Are they here? Are they overseas? Are they in pension funds invested for the next 50 years? It all makes a difference. But again, the change that happened between 1945 and today is not in your portfolio. It's just one more data point. And so who owns the stock market doesn't change. And as the trends change, neither does your portfolio. Leadership in the stock market, it's always changing. This is a performance quilt. You've probably seen them before, of country rankings, what stock market, which countries were best and worst for an entire year. So each one of these blocks is 1 year of data, 22 countries. And, who would have thought that over the last 20 years, the top market on earth was Denmark? Anybody have that? I don't, I haven't had a large allocation to just Denmark. Um, checking data is very important. Um, but the real takeaway here is you can see how they constantly change. Denmark's number one, but back here in 2016, it was number 22. It was the bottom of the heap. And the question is, are you going to sit there for an entire year and get the worst returns on earth when there are other places you could move if you're going to adapt? And that's the key. Um, it would be almost impossible to try to guess which one of these are going to come up best, even if you knew who was going to be best over 20 years. It doesn't do you any good. You need to follow trends as they develop. Never guess, follow the money. The global stock market is quite schizophrenic, and I mean that actually as a compliment. It wouldn't make any sense if the rankings were the same year in and year out. Wouldn't be much fun either if you enjoy this. The stock market has to change. It has to change all the time. Otherwise, it wouldn't offer investors a risk premium. And that means we can make higher returns in the stock market because it is hard to figure out where to invest at any given time. So we get rewarded for the extra risk with a risk premium. If we do things right more times than not, we're going to come out ahead. From the chaos that this looks like, it's one of the reasons that we emphasize it's important to follow the trend, don't predict it, and whatever you do, don't just buy one thing and sit on it. Otherwise, even if over the 20-year period you're going to be okay, there's going to be times where if you own Denmark, you're at the bottom or near the bottom of all returns on earth. You don't want to do that for years at a time. And so you need to pay attention to what's going on and adapt your portfolio to the current market environment. There was a recent study by Strauss and Williams. It was actually entitled How to Diversify Differently. That's the important part. Time varying correlations, determinants, and regimes is the rest of it, which is why we're not going deeply into this report here this morning. But the findings concluded, and I quote, major asset classes experience substantial changes in correlation over time, challenging the fundamental premise of buy and hold strategic asset allocation based on the assumption of time invariant correlations, meaning they don't change over time. Their results show that by exploiting relative strength to take advantage of the variation in correlations, the way asset classes change, investors can gain valuable insights into how to diversify differently. They noted that while their relative strength portfolio did not outperform every time, nothing does, nothing stays at the top of the list on its own. It offered very consistent performance through decades of historical returns, and it outperformed the benchmark on a risk-adjusted basis during the entire sample period. So this can give you an advantage. It doesn't mean it's perfect. It doesn't work better than everything else all the time. But more often than not, it's going to increase your probability of having a profitable trade. And that's what you're looking for. The research also stated that as much as things change, some changes are a little longer lived. The research shows that because correlation regimes, the correlations between asset classes, tend to be longer lasting, investors can improve their chances of success by at least avoiding asset classes that are out of favor. You don't have to hit a home run every time if you can just stay away from what's hurting your portfolio the most. So it's just as important to know what's not performing than to know what's performing. The research indicates that because correlation regimes can be longer lived, historically, investors could have improved over buy and hold strategies by using a tactical approach and shifting their allocations between asset classes that are performing well and staying out of the ones that aren't performing well. So, meaning not sticking with historical averages, but adapting portfolios to current market trends. Find the trend, follow the money. That's what we do here. Investor Resources, we run the RPM system. RPM stands for returns equal prices and momentum. That's what drives your returns. The price, what'd you pay for it, and the momentum. Where's it going? And it needs to be rules based. Boy, is this important. In times of chaos, like we're in right now, if you don't have a rules based portfolio, it's very easy to get lost. It's very easy to not know what to do instead of saying, I've got a plan in place. It's a fixed plan. We're going to apply that even in this chaotic market, and we're going to come out ahead. We do that by first defining the inventory. We don't have to look at the thousands and thousands of things that are available worldwide. We already have an inventory defined for the portfolios that we use, for the models that we manage, and we rank those. We go through those, and we determine the criteria of how do you get in the portfolio and what's going to make us sell. And that sell side is one of the things that is completely missing from the buy and hold investor. They'll buy stuff, but you never sell anything. And that's the problem. You need to get rid of those things that aren't doing well when they aren't doing well. And that's very important. And we always know what it's going to take for us to sell something when we buy it. It's critical. Then you never stop reevaluating the portfolio. You continue at all times to make adjustments as they're needed. Things are not static. Things are going to continue to change. You need to be watching the market. What's the market doing? What are the changes doing to your portfolio? That's the only thing that really matters. What's in your portfolio and how is it reacting? And then apply the rules and make the changes that you need to at the time. That's what takes the discipline to go in and do things that aren't always necessarily comfortable. But that's one of the oldest sayings in investing. What's comfortable is rarely profitable. You have to be willing to make those changes. And after you're comfortable with your process, once you've identified that your system is working for you, then you need to just follow the rules. This will help you keep in line. It's step by step by step to help you get through, especially times like these when things are more chaotic than normal. But at any time, panic doesn't set in. You can still apply the rules, and your model is still in place.